Hi, everyone, and welcome to the next edition of Qapita's LinkedIn Live, when we're having conversation with industry experts across Asia on various topics. So today, I have a really great guest with me. It's Uyen from Vialto Partners, and we'll be having a conversation about equity compensation tax rules and considerations in Singapore. So to give you a quick introduction about our guest here today, so we spent a number of years as a senior manager at Vialto Partners, working with many organizations, both listed corporations and startups, on helping them navigate all the complexities of equity compensation and share plans in Singapore and across the region. So thank you for joining us today and welcome to the show. So is there anything you wanted to, maybe before we kick things off, share about yourself and your experience with equity compensation in Singapore?
Thank you, Amit, for a very kind introduction. So as mentioned by Amit, I'm a manager in Vialto Partners Singapore. So during my work in Vialto Partners Singapore, we have helped companies as well as individuals with regards to their global mobility matters, especially on the equity compensation. And as Amit has mentioned, we have the companies as well as individuals to at the planning stage to identify what are the individual tax implications in order for the companies as well as the employees well aware of the implication before they participate in the plan, as well as the compliance side, how to file the tax return to be compliant with the tax rules in the countries. So equity compensation tax is a rather complex topic, which I would recommend that if you have any further questions after this podcast, feel free to reach out to Amit or myself so that we can address your questions later on. So this podcast is only on general knowledge, so it should not be relied on for your individual situation.
Yeah, no, that's absolutely right. And as we all can appreciate, it's a very complex area, but what we'll try to do is introduce you to some key concepts and share some high-level information. And then, we're more than happy to have a chat with you around any specifics. And just to consider, as part of our audience, we actually have people dialing from not just Singapore, but also Malaysia, Indonesia, India. So as you can appreciate, it's not just Singapore companies who give away equity to their local employees. In some cases, it's also international organizations. And as you mentioned, we also work in the space of mobility. But before we get into more complex scenarios about mobile employees and so on, let's kind of just start with from the top. So to kick things off, would you be able to provide some background information about Singapore taxation and how it works specifically around equity income?
Okay, sure. So Singapore taxation is on territorial basis, so only income relating to Singapore employment is taxable in Singapore. So people often have the perception that Singapore tax is rather simple with very competitive tax rates. However, when it comes to equity tax, it's another story. Singapore actually takes a very unique stance on equity tax compensation, where it takes an all or nothing approach to the taxation of equity awards, where only grants of equity during the Singapore employment will be considered as Singapore source, while grants that made before or after the Singapore employment are considered as foreign source and will not be taxable in Singapore. This is a very different approach compared to most of the OECD countries who adopt the principle of sourcing of equity grants over the vesting period, whereas Singapore source based on the grant date. So because of this discrepancy, it may cause issues such as double taxation, especially for mobile employees who move across different countries during the grant to vest period.
Yeah, no, okay, that's quite interesting. And you mentioned mobile employees. Would you mind kind of explaining a little bit more how does this unique rule impact mobile employees around sourcing?
Sorry, can you clarify?
Sorry, you kind of just mentioned the mobile employees. So would you mind explaining a little bit more about how this kind of unique rule impacts specifically mobile individuals. So provide a bit more clarity around the sourcing rule in Singapore, how it differs to other countries.
Okay, sure. Yeah, so for mobile employees, as mentioned, where if the grants are made during the Singapore employment, they will be all the grants will be subject to tax in Singapore. And if this individual move to another countries where that country follow the sourcing rule, as mentioned, like those OECD countries, the individuals will be taxed against based on the prorated period of that individual's employment period in that countries. So here in Singapore, we are taxing 100% of the grants, and again, in those countries, there will be a portions of the grants that will be taxable for these individuals. And these issues will be even more complex for non-Singapore citizen because for non-Singapore citizen that leaving Singapore for at least for more than 3 months or ceasing Singapore employment, there will be this tax clearance requirement that applicable to the employer. And in this tax clearance, the employers will be required to report all the unvested or unexercised equity awards that have been granted to these individuals during their Singapore employment. So there will be this deemed vesting that is applicable to these individuals. That means they will have to pay upfront tax even though the shares may not have been vested or have not been exercised by them. This can be a showstopper to high-level executives who have been granted with a significant amount of shares during their Singapore employment. So planning is required in advance before such move. Otherwise, it will not be a very pleasant surprise to these individuals when they are aware of such tax implications for their move.
No, understood. Yeah. So deemed vesting, deemed exercise is a very important topic. So I'll come back to that so we can do a bit more of a deep dive, because I think that's a common topic that raises a lot of eyebrows and catches people by surprise. But I think before we kind of do that, I also just want to mention that anyone kind of listening in at the moment, if you have any specific questions for us, feel free to drop them in the comments, and we'll be sure to address them as we go. What I want to talk about is that you mentioned that if individual potentially due to their mobility may be double taxed in different jurisdictions on their equity income as a result of that relocation. Is there like any relief potentially available to those individuals in the company? How can they manage it?
Yeah. So double taxation is again a very complicated area that need to be reviewed from both the home and host countries, as well as whether there's a tax treaty in order to find the best way how to minimize such double tax. From the Singapore's perspective, there can be foreign tax credit that can be claimed for the doubly taxed income on the equity income, provided that the qualifying conditions are met. So a good news is that with effect from year of assessment 2022, which is calendar year 2021, the individual would have 4 years from the year of assessment to make the foreign tax credit claim. Previously, the time bar was 2 years, so now it has been extended to 4 years, which will give the individual more time in order to claim such credit. However, it will still be a challenge for individuals whose holdings, for example, options with long exercise period beyond the 4 years, because if they exercise the options beyond the 4 years, then they may not be able to claim the tax credit in Singapore anymore.
Yeah, understood. So yes, and obviously this can get quite messy as we'll talk about it. So maybe what I want to do next is let's just take a step back and let's consider a scenario when it's a Singapore company, has Singapore-based employees who are citizens, and they receive, let's say, maybe options as part of their company scheme. So from the company and employee perspective, in a very kind of vanilla standard scenario, do you want to maybe through like a high level, what are the key milestones when usually in some circumstances a taxing point may arise, for an option plan? So I want to kind of start with the basics, and then maybe we can move on to the more complex scenarios. So that way people don't, freak out immediately about the complexities. So let's start maybe from a Singapore local scenario. So what are the key taxing points need to be aware?
Definitely. So, per the Singapore Income Tax Act, the shares will be taxed when the rights or benefit is exercised, assigned, released, or acquired. In simpler terms, that means when the shares are vested to the individuals or the individual exercise the options. Unless there is a selling restrictions or moratorium imposed on the vested shares or exercise options. So normally the taxing point will be at vest or at exercise. However, if there's a selling restriction or moratorium in the share plans, for example, even if after vesting or exercise, the individuals cannot sell the shares until, for example, an exit event happened or until after 3 years, for example, then the taxing point in Singapore will be delayed until such selling restriction or moratorium is lifted.
Okay. So that seems quite clear. So if I'm an employee and I receive, let's say, options, so on grant, nothing really happens because there's usually a vesting period, so no taxing trigger. If I have options and when they vest, once again, no trigger for taxing because I haven't exercised them yet. And in a future point in time, when I exercise and receive the actual benefit in the form of shares, then that usually triggers a taxing point, unless there's any restrictions from me from being able to sell them. So that kind of makes sense. And I guess like an important thing to consider in Singapore as well is that there's usually in a lot of countries there's two elements: so income tax and potential capital gains tax. So I think like important thing to know that in Singapore capital tax gains tax regime is actually non-existent. So the one thing that you need to be mindful of as an employee would be your income tax trigger. So that makes sense. So that was an option scenario. And then as you explained, in the case of, let's say, RSUs or like RSAs restricted shares, usually there's no concept of exercise. But once you receive the unrestricted shares, that's usually when the taxing point is triggered. Yeah.
Yeah,
Okay.
you're absolutely correct. So there's no capital gain tax on any shares after the share has been vested or exercised by the individuals, unless the individuals is considered as a trader in the eyes of the tax law. Then that will be an individual situation basis. But generally, there's no capital gain tax here.
Okay, sounds good. All right, so I think this kind of the basic scenario is good to understand, and maybe what I'll ask you a little bit later is about kind of the share plan or equity plan design and what are the things companies need to consider. But now that we've covered sort of the local Singapore citizens more vanilla scenario, let's talk about the thing you mentioned around deemed vesting or deemed exercise rule. So do you mind explaining that one more time? Because I think it's a quite important point. So how does it work? Who does it impact? What is it?
Sure. Okay. Yeah. So deemed vesting or deemed exercise rule would only be applicable to non-Singapore citizen who is leaving Singapore for more than 3 months or ceasing Singapore employment. So where such scenario happens, the company who's employing these individuals will have to file this tax clearance return, which is the form IR21, 1 month prior to their departure or cessation date. So in this tax clearance return, the company will need to report any shares that have been vested or exercised within the years, which is the case that we have just discussed, as well as any unvested or unexercised shares that have been granted to these individuals during their Singapore employment. And the market value that to be used for this deemed vesting will be the value 1 month prior to their cessation date.
Okay.
Or the grant. Yeah. So that as mentioned, that means that the individuals would need to pay taxes on these unvested shares or unexercised options, so that there will be some cash flow issues to these individuals as well, because they have not really received the benefits of the shares and now they have to pay tax upfront. However, there's a good the silver lining in this, where there's this reassessment of deemed gains avenue by the tax authority. If in the event that the actual gain upon actual vesting or exercise is lower than what have been reported in the deemed vesting tax return, then the individuals would have 4 years from the year of assessment of the deemed gain to go back to the tax authority with supporting documents, for example, the actual vesting documents, the share price that have been vested or exercised, to request for refund. If the share price is actually higher than what have been reported in the deemed vesting return, the good news is that there would not be any additional reporting required.
Okay, sounds good. Yeah, so I think this is a very important topic, and just to illustrate, because I'm personally in, could be in that situation, being a foreigner in Singapore. So if I was to come to Singapore now and receive, let's say options, let's say I receive 100 options and they vest in 3 years' time. So ordinarily, if I was a local employee, then the taxing point will be triggered when I ultimately exercise them, 3, 4, 5 years later. All right, so that's pretty straightforward. But in this case, if I was to receive shares today, and then leave Singapore a couple months later, what you're saying is that because of the deemed vesting, deemed exercise rule, even though they haven't invested, even though I haven't actually exercised them, from the Singapore's tax authority perspective, they'll deem as if I have, and I'll be liable to pay income tax at that point in time, right? So this is the big difference in those cases. So, and as you can explain, obviously it's something, and I won't be able to transact on those shares and sell them out to fund my potential tax bill. So are there actually any alternatives available for companies and employees to manage it? Because, for many, it can come as a potentially unpleasant surprise. So is there anything that can be done to manage this?
Yeah, there's sort of definitely alternative to such deemed vesting, where the tax authority allow company to submit this application for tracking options, where it allows the employer to track the unvested equity until they actually vest or exercise to report the actual gains. However, there's a lot of stringent qualifying criteria in order to qualify for these tracking options. Employer would have to demonstrate that they have robust HR processes in order to track the unvested or unexercised equity, as well as a very good track records in terms of tax compliance, not just individual tax, but in terms of corporate tax as GST, etc. And also the company need to demonstrate that they meet the capital requirement, which is a stringent requirement that most companies might not be able to meet. So that is for tracking options. Where that is not possible, we have seen companies who have considered accelerated vesting, where they accelerated the vesting to be within the Singapore employment period, so that the individuals at least have some cash to settle the taxes. But again, this might not fit the originally intended purposes of the plan, and the individual might not be able to enjoy the capital gains later on. And also company may also consider giving loan to the individuals in order to settle the taxes upfront. So there potentially be income tax implication on interest-free or subsidized loan benefit as well. And also companies may also consider tax equalization. That means company will bear the taxes first on the deemed vesting, and only when the shares are actually vested or exercised, then the individuals can reimburse back to the company through the tax equalization calculations. Again, there are various alternatives, but there's no one fits all kind of plan. So companies need to understand what is their original intention of this plan, what's their reward philosophy, future growth plan, as well as their retention policy. Because once the shares, for example, have been accelerated go through
Yep.
accelerated vesting, then the company may not be able to retain this individual anymore because the individual
Right.
can leave the companies. So these are various considerations that the company to look at before deciding on what options that they would like to go for.
Yeah, that's right. And yeah, and I guess the best outcome is like, yeah, there are alternatives, but there's no perfect one, and there's pros and cons for each. So, tracking option sounds good, but eligibility is quite strict. So large listed organizations may have some success with this if they're able to sort of convince the authority they'll be able to do that, but it may not be suitable for some startups who don't have enough history, they won't qualify. Once again, cash settlement could be good, but once again may not be appropriate in some cases, because a lot of the time it's the whole concept of equity compensations, long-term, alignment between employee and a company. So it's clear to see is that, especially in Singapore, where there's quite a lot of expats and employees receiving equity, it's quite important to sort of plan for these potential scenarios. Because once again, employees could go on an assignment, may not even necessarily leave the company, right, or terminate their employment, right, because the deemed vesting exercise could be triggered sometimes in those circumstances. So I think what might be helpful is I think you've kind of explained a few interesting concepts. So for the local employees, things are relatively straightforward and fairly easy to understand. But we live in an interconnected world, and a lot of companies in Singapore have international employees or people coming in and out on assignments. So now you've actually prepared something, an illustration to go through, like a hypothetical scenario to try to kind of explain both the sourcing element, the deemed vesting exercise, and how it all works. So would you mind running us through that example you've put together?
Yes, definitely. Okay, so Amit here is an Amit is a non-Singapore citizen who started working in Singapore from January 2021 under Qapita Singapore. So in March 2022, he was granted with 90 shares by the company with a 3-year vesting period. In March 2023, as part of his career advancement, he was sent to France for a 3-year assignment. So firstly, we'll be looking at the all or nothing rule. So Amit was granted with 90 shares in March 2022, which is during his Singapore employment. So everything will be considered as Singapore grant and will be fully taxable in Singapore. So in March 2023, because he sees Singapore employment to go on a French assignment, he will be subject to the tax clearance requirement. So even though the 90 shares have not been vested to him yet due to the 3-year vesting period, he will be subject to tax in advance at this point of time in the tax clearance return on the full 90 shares. So the share price that will be used at this tax clearance return will be the share price 1 month prior to the cessation date. So here there will be cash flow burden, as mentioned, to Amit because he has to fork out some cash to settle the taxes. And also the deemed gains might be higher than the actual gains later on, even though we hope not. Yeah. So 3 years passed, and now he actually vested with the shares in March 2025 when he's in France. So because of the sourcing rule by OECD countries, including France, he will be taxed on the 60 shares prorate, which is a simple proration of his France employment period across the grant to vest period. So again, there will be double tax exposure for Amit between Singapore and France on these 60 shares.
Okay.
Yeah. So here's the quick illustrations on the implications of the Singapore taxation on equity that we have discussed so far, so
Yeah.
that you
Okay.
can appreciate the intricacies and the complexities of
Yeah, correct. Well, the main takeaway for me, I've actually never been to France, so I look forward to expanding Qapita there. So that'll be interesting. But yeah, so I think this is quite helpful to kind of visualize and understand exactly how it works, right? So the first point about because the grant was made while I was hypothetically in Singapore at the time, so that's why it's subject to obviously the tax legislation in Singapore, and then because I've left the country to move somewhere else, that deemed vesting kicked in as well. And then once again, like because I'm in a new jurisdiction, you have to consider the rules on both sides, right, and how they interact as well. What I think might be helpful now, I just want to clarify and point out here. So let's say in this example, I would have started employment earlier and only moved to Singapore in March 22. But let's say the grant was made while I was still in another country in January 22. So in that case, how would that actually impact this? So if the 90 shares were allocated to me while I was employed in Australia, for example, where I used to be before Singapore.
Okay, so that's the flip side of the coin where you will not be taxable at all in Singapore, even
Yep.
if uh, you are still in Singapore during the actual vesting. So again, that's a very unique rules on Singapore taxation on equity income. We look at the grant date to determine whether it's a Singapore source grant or not. So while people can find that the investing rules is very complex and cumbersome, the flip side of it is there might not the employee might not have been taxed on any foreign grants. So that's the better side of the story.
Yeah, sounds good. And look, there's nothing perfect in the world. There's pros and cons in both. By the way, I guess like the easiest way to sort of summarize and think of it from a Singapore tax perspective, whatever happens in Singapore is quite important. What happens outside of Singapore is in a way irrelevant. But from individual receiving it, you also need to consider the rules outside, right? So there's the two, as I said, the sides of the coin. Okay, so I think that was very helpful. So thanks for kind of explaining this. And I guess what I want to do is like change the topic slightly. So we've talked about kind of different scenarios, how it works for employees. I want to sort of shift the focus more from the company's perspective, because I know you've had experience, in your career working with listed and unlisted companies, both Singapore and international. So based on kind of your individual experience, working with many of your clients, what are the common sort of pitfalls or mistakes that employers face when they create new schemes, they create ESOP or other equity programs? Like what do they fail sometimes to consider from the individual tax perspective that they really should keep in mind? What would be kind of your key tips and tricks and suggestions for anyone considering rolling out a scheme in Singapore?
Sure. So here are the commonly seen pitfalls that I have seen from some of the clients. So at the early stage when the company is looking to roll out the new plan, there was lack of review from the individual tax perspective on what is the implications of such
Mm,
plan. So again, when the plan is already rolled out, the employer and employee would then have a very unpleasant surprise on
yeah.
the tax implications because they did not expect such implications when they were putting out like the term sheet, working with the lawyers
Mm,
from the legal perspective, but because there was lack of review from the individual tax perspective, it might be a bit late for the
mm,
employer as well as the employees to go back and rectify the plan
yeah.
after. Yeah, so and also there's also lack of employee communications when rolling
Mm,
out of such plan, and employees are not aware of the implications of participating in such plan, causing a low take-up of the plan or even dispute when the taxation event happens. So, and also for global companies where the share plans are administered from the headquarters,
yeah.
the local HR might not have the information from the local level, and that's causing some issues with the reporting obligations because such equity information might be missed out from the employer's reporting because the local HR does not have such information, and there's disconnect between the global and local. So my suggestion is that when you would like to roll out the plan, of course, with all the other implications, you can ask IMEET for the advice. But from the individual tax, especially for global companies, we would always recommend that to identify what are the major countries that you expect to roll out the plans and seek advice from the individual tax perspective for this country at least, so that both the employer and employees are well aware of what they are getting into. Yeah, and then after that, there should be employee communication either through FAQ or the yearly or quarterly communications every time there is like a new grant, so that the employees are well aware. And also there should be communications when the tax season comes, so that again the employees is aware of the implication. And of course, for any plans that very complicated, not the plain vanilla kind of plan, it's important that needs to be reviewed in great details. And sometimes if the position is not clear, then we might even need to seek some clarification from the tax authority. So all of this should be done in advance, so that there will not be any issues downstream when it comes to reporting obligations.
No, understood. Yeah, no, thank you. I think that's quite important to consider, because your plan might be well structured and well drafted, right? And there technically could not be any issues, but if you're not really aware of all the potential scenarios, then you might just run into some unexpected trouble, down the road. So it sort of pays to do the homework and ensure you plan ahead. Because the last thing you want to do as a company is that you want to create a scheme that benefits your employees, but ultimately all they end up with is a negative experience because of unexpected tax bill and complications. Then defeats the purpose of providing that, and as part of their reward for being an employee of the company. Okay, so I think that's quite important. So it's a good suggestion to keep in mind. And the other thing I want to do is that there's obviously sometimes often a lot of support for large listed corporations, and things may be a little bit more straightforward for them, especially, for example, you mentioned like if there's a deemed vesting, then you need to consider the value of the company shares 30 days before that specific time. But how does it actually work for like unlisted companies? Because in Singapore, Southeast Asia in general, there's a lot more startups that hire startup employees in Singapore. So how would that work if their shares are not publicly traded in private markets? How can a company even obtain the valuation of the shares for tax reporting purposes? What is the process they should follow?
Yeah, so under the Singapore Income Tax Act, the taxable amount is calculated by reference to the open market value of the shares at the taxable event. So for startup or private companies whose shares are not publicly traded, then the comptroller may use the net asset value of the shares in determining the taxable shares gains. However, this does not mean that the net asset value can be used as the default by all companies for valuing its shares. So it needs to be validated, and we normally recommend to have an independent third-party valuation to validate any valuations that the company used in the reporting of such equity gain. So once the evaluation is done, we also advise that the company retain supporting documents as to substantiate the valuation. we also, based on our experiences, we have seen companies who have written into the tax authority to explain why they actually applied the net asset value. So again, it is not a default that company can just proceed and apply the net asset value. The company will need to seek approval from the IRAS that they can use such net asset value. But we have seen certain successful cases from that. So if you need any assistance on that, you can reach out.
Yep, understood. Yep. So once again, picking the appropriate methodology is quite important. You shouldn't blindly just follow one. So it may vary case by case. So okay, so that's noted. And I guess the other tricky thing you might consider is that, especially in unlisted space, a lot of companies offer different kind of designs of programs. So now we talked so far a lot about options or shares. We mentioned RSUs, restricted shares, but some companies sometimes often run cash settled to like phantom programs. So do you know like what would be the key differences to consider from like individuals or from the company's perspective if they offer like a phantom or cash based plan instead of your kind of traditional ESOP or RSUs?
Sure. Yeah. So the Singapore taxation on cash-based plan and share-based plan are vastly different in Singapore. For share-based awards, the rules follow as what we have discussed so far, based
Yep.
on an all or nothing approach.
Mm.
On the other hand, the cash-based award are treated in a manner that's similar to bonus, where the payout are taxable only to the extent that it relates to the Singapore employment. For example, if Amit received a cash settlement in September this year that relates to the past year performance, where he exercised his Singapore employment only for 6 months last year, and prior to that he was in Australia. Then only that 6 months will be subject to tax in Singapore for that cash payout.
Okay.
And it is important to note that if it's just a change in the settlement mode of the plan, that means that the employee still has the underlying rights to the shares, rights or options. The normal equity rules will still apply instead of the rules on the cash-based plan. So it's important to review such cash-based plan, because even though we say cash-based plan, it might be actually a share-based plan that's settled in cash. So there are also difference between the two. So we always recommend that the cash-based plan need to be reviewed as well, even though the tax treatment might be much simpler because it can be treated like bonus. But whether it's a real cash-based plan or not, review needs to be required.
Yeah, correct. And it's also quite similar from the, accounting the share-based payment expense, right? Because you need to determine if it's equity settled, cash settled. And a lot of plans may not be pure cash settled, pure phantom plans. They could be actually equity linked, but there's a provision for companies, some circumstances to cash settle certain awards as well, right? So this can be like, I'll be difficult to identify. So it's quite important to keep that in mind. Okay, no, I think that was quite helpful. So I appreciate that. So I think I had maybe a couple final questions. We want to wrap it up. You mentioned that from the company's perspective, it's quite important to sort of communicate with employees and individuals to educate them. In your experience, have you seen any good examples of what you felt like worked well? Like, what would be your suggestion for companies? You may want to consider maybe doing something on a quarterly basis or annual. Like, do you have any good examples of what's the best way to explain all these complexities to individuals who may not have the background? You and I, we've been doing this for a while, so for us, it's a little bit easier. But for someone who is receiving shares or options for the first time, what's the best way to help them out?
Sure. Yeah. So as mentioned, company can have FAQ, so that the employees can refer any times that they have questions regarding the share plans. And also, as and when there is a new grant, it's good to recap on such information, to have those seminars with the employees where the tax expert can be invited to deliver on what are the implications of the plan. And there can also be one-to-one session afterwards where the tax advisor can provide on an individual case basis to individuals. And also for employees who are moving across countries, companies we have seen good practices where companies have those pre-move consultation, so that the individuals are well aware of the implications before even signing on the assignment letter. Because once we have seen cases where individuals sign on the assignment letter, everything have been settled. Then we have the tax briefing with them. That is when they suddenly realize that, there's a huge tax bill on the equity income, and that might not be a great experience for them. So such pre-move consultation, so that individuals are well aware of what they are getting into, would be a good practice.
Yeah, and I think it's very similar to what you suggested for companies, like do the homework early as you create a plan. And once you've done that, before you issue the letters to employees to accept the awards, help them understand, at that point in time. So when they agree to it, when they sign it off, when they accept those grants, they are well informed about everything that's going to happen for the next couple of years. So, all right, so that was super helpful, I think. So I appreciate your time. I think we're going to wrap up shortly, but before we do, anything else you wanted to mention on this topic? Is there any other final advice you have for companies or employees listening in? Will be good resources to check out, or anything else you would suggest?
Yeah. So I think if you are companies that are looking out to roll out a new plan, of course you will engage like Qapita as well as the lawyers to for the various matters. But again, do not forget on the individual tax implications, because as mentioned, it can be a showstopper to any individuals joining the plan, or even if you are consider of moving employees across the globe. And also you can look at the IRAS portal for at a starting point, if you would like to know some basic information on Singapore tax as well as Singapore taxation on equity income. However, as mentioned, equity plan, double taxations, all these are very complicated matters which need to be looked on a case-by-case basis. So it would be recommended that you do your due diligence, so that both the employers and the employees will be well aware of the implications to meet the compliance requirement. Because in Singapore, there will be penalties as well as other enforcement implications if companies do not report such equity gains or any miss out in terms of the employer's reporting. So it's important that this need to be looked at seriously. So not just for the employee experience, but also to ensure that the employers is compliant with the tax rule.
Okay,
because
perfect.
I mentioned just now, for tracking option, for example, in the tracking options, the IRS actually look at the records whether the company has been a good taxpayer, not just individual tax, corporate tax, GST. And so it's our experience that the IRS will look at the past history, that the compliance of the companies. If the company, for example, you are a startup and you would like to claim for certain concession in terms of taxes and all that, the IRS will also look at your compliance history, and we do not want this to be a barrier to you getting any grant or any concession in terms from the tax authority.
Okay, understood. So look, I know you work with a lot of companies and even employees and executives, helping them out. So if anyone watching this has any questions, want to reach out to you for help, what will be the best way for them to contact you?
Or if you would like to reach out to me, or you have any questions after this podcast, feel free to reach out to me through my LinkedIn account.
Yep. Awesome. Yep. And obviously anyone within Qapita Network that we work with, if you want to have a chat with, we're more than happy to connect you both as well. So do reach out to us for any help. I think with this, we're probably going to leave it there. So once again, thanks very much for your time. I think that was super helpful. I know we covered some of the a bit more straightforward aspect, but obviously some complex scenarios. And I think we can all appreciate things can get a little bit out of hand if you don't do the homework and planning up front. So I think that's one of the key takeaways. So yeah, hopefully everyone got a little bit out of it and has a bit more comfort and understanding about the rules of equity compensation taxation in Singapore. So once again, thanks very much for your time. That was very, very helpful. So look forward to chatting with you next time.
Yeah, thank you, Amit, for the invite. It's great chatting with you, and look forward to future collaborations.
Awesome. All right, thanks everyone. Cheers. Have a good one.